All right, the markets typically start Mondays off very quietly, and today was no different. We have a holiday week coming up with no market open on Friday. We have the PCE coming out. So, again, there's not going to be much difference in that PCE from what the CPI, has told us about. So I don't think necessarily the market's like very sideways going into that report. I think there's just not a lot of market move. The markets are extremely bullish. We broke the record for the longest move without a 2% decline, and we're just building that record going forward. We've had one of the strongest rallies over 100 days going into Friday's close, 21 weeks. In fact, we've never been this bullish over a 20-week period that we've gained 17 weeks. So we're 17 out of 21 weeks, and we've gained 20 some odd 7%. Like, we've never seen that before. Like, it is historically a bullish move. So it's just a grind to the upside. There's not a whole lot of momentum to spark a new trend, a new a momentum move to the upside. But there's obviously no reason to sell either. And so you get these little near-term declines, like I'll show you we got today. And now what will we get for the rest of the week? So I'll kind of break down what my expectations are based off of this. The patterns at today's really small, really Friday's and today's really small declines have set us up for. So we'll talk about that, what's driving the markets here for the year to date and specifically here the last couple of days and today. And then that sector rotation looking very strong, very broad. So we'll break down some of the breadth indicators, and then our trade idea as a stock in that kind of transport area that broke down. And that can be an area that breaks down first. So we'll take a look at how to trade one of the bellwethers in that particular area. So let's go ahead and get started. Today is Monday, March 25th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here with this thumbs up icon. Click on that. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. It's a big deal to us. That's why we always ask. So we got up to 76, so that's great. Again, the goal is always 100. So thank you for those that like these day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator as always. So you can see second straight down day, but extremely small loss today, like down 1/3%, but the very, very small range. The momentum line dropped again to extreme lows for a second straight day. But again, not because of it's a significantly down day, but mostly because of the small range. So you have to kind of you have to look at, okay, what's the reason why? Is it dropping because we really sold off, or is it dropping because of the range? So this is actually way more bullish than had to be dropped 1% or 2%, right? Of course, we haven't dropped 1% or we haven't dropped 2% in a long time. But you notice that the momentum line, not only is the momentum line extremely oversold, but the near-term line has dropped into bearish territory. Again, this has been a recipe for the market last, I don't know how many times, 1, 2, 3, 4, 5, 6, 7, 8. Now the 9th time that we've had this. And now this is the first time that we've had such extremes for 2 straight days. But again, in the past, we get a little bit of a near-term decline. We bounce right off of this. The near-term line, the intermediate line is rising. It's above the 90th percentile. The market sentiment line is rising again. It's above the 80th percentile. This is a very, very strong trend. So until something changes, until this precedent changes, we have to expect that the S&P will just follow its recent precedent of just bouncing right off of this near-term low. And really, for a lot of Mondays here, Mondays have not been a good day for the S&P. All right, despite a small loss on the NASDAQ, which again, 1/3%, the intermediate line did rise back above the 80th percentile and above the market sentiment line. They're both rising. The momentum line is still oversold, but not as extreme as the S&P, and the near-term line is not down into bearish territory. It's not even below the lower half, but it did fall out of bullish territory. but hasn't really gone bearish yet. So not quite the same thing that we see on the S&P 500. When you look at the Dow Jones Industrial Average, we had a little bit bigger of a loss Friday, and we followed through with that again, 0.4% down. Again, extremes, but this one's a bigger drop, and the near-term line also down. So we'll see. Like, again, the intermediate line's above market sentiment. It's rising above the 80th percentile. So again, the odds are we'll bounce right off of this intermediate confirmation signal and bounce right back up. Right, that's been what we've done in the past, and we expect that we'll do it again here until we see something different, right? Until we see something different there. And then finally, the Russell 2000 also had a pretty significant drop yesterday. It was actually up today, or excuse me, Friday. It was actually up today. Again, momentum line extremely oversold for a second straight day. Near-term line into the reverse, into bearish territory. The intermediate line crossing up above market sentiment. They are not above the 80th percentile, so a little different from the other large cap indexes, but still the same concept. Still bullish, pretty strongly bullish too, because it's pretty close. And above market sentiment. So again, you expect that we'll bounce off this near-term low until we see something different, right? Until we get a bull tag that doesn't bounce when we get that bull tag. Let's take a look at the weekly chart here. And you can see, again, we are in the 92nd percentile of how big this gap is between the 10 and 40 week moving averages. We do have a higher close so far this week, obviously a lower high point. Again, only one day. We only got 3 more days left. Remember, the holiday shortened week, no trading on Friday. So keep that in mind. Looking at the 3 green arrow chart, you can see we have 3 green arrows in the S&P and the NASDAQ and the Dow, but not quite on the Russell 2000 yet. The momentum line's so close, but it's not above 0 yet, so we don't have that third green arrow. So now that we got, again, we got 3 green arrows at the height of the last near-term run. Now we're getting a little near-term pullback. Again, is this going to stay 3 greens? If we drop below the moving average, then obviously it's not going to. So, we need this dark green shading to last more than one little near-term pullback. And again, we expect that it will. I expect that it will until we see something that changes precedent. We expect that it will just follow suit with what it's done here previously. Still very strongly bullish on the DMI, well above 30 on the positive. Not quite below 20 yet on the negatives. That's kind of interesting phenomenon that we have going on. Just can't get that negative DMI below 20 again. The RSI and the CCI are still at very strongly bullish levels, above 60, still above 100 after getting above 200. So very, very strong levels on these oscillators. Looking at the Ichimoku cloud, we do have a very strong trend still above 22, and so I can't move that up quite yet, but we're still above 22, still above 90 over here on the trend noise balance, still well above the green line, very strong rate of change. It's been about as steady as a bullish trend as you could possibly have here. Looking at the Bollinger Bands and the Keltner channels, we are not above the upper Keltner channel. We were on Friday. We dropped back down, or we were on Thursday, excuse me. We dropped back down on Friday and further below it, but still in the upper quartile of the bandwidth. So it hasn't really broken into the lower half of the bandwidth yet. We're back to having green dots, so the bands are back outside the Keltner channels, and you still have some positive momentum here. So everything's still looking pretty darn bullish. If you look at today's intraday range, you can see we did get a lower high and a lower low. We used Friday's low point as the resistance on this move higher. We're still got some volume to move through if we're going to move down to the value area where some support is, because we moved up so fast after the FOMC meeting. So we have now completely filled in the gap from Thursday morning, and we'll see if we continue to push lower there. Obviously, we did get back to 100 on the on this, but the channel, the size of the channel, the width of the channel is extremely low down there below 4%. And again, you can see the low point. It's going to move up slowly. It's going to be for about another week or so. It's going to be right there. So again, barring any new 4-week high point that expands out in a big way, what's already really extremely low can get even more extremely low once we get this through the system. So again, after probably the middle of next week is when this will go off. So that kind of gives us how much time. If we don't get a new high point, then your green line is going to be back below 70 again. and we're going to be set up for a squeeze, essentially a squeeze play, an opportunity for the market to make a trending move in one direction or the other. Looking at you saw the volume and the trading. You saw the trading range is extremely small, 1.34 points. The volume at 48.5 million. These are very, very low levels. When you put them in context, 48.5 million is way below the average. The one was at 1.34 points, way below the 52-week average. So the actual normalized ATR is down to below 85% again. So flirting with the extreme lows again there. Not surprising to see the VIX up on a Monday, but not really moving very much. Still right around that 85% mark, and you still have an extreme low on the VVIX. And the VVIX and the VIX are back to a strong positive correlation. So, again, all these other extreme lows produce pops in both the VVIX and the VIX. Something you would expect to see with the VIX as low as it is to around that 85% mark, as well as down here below the 50-day moving average. Trying to get back above, and we really broke down post FOMC. So we'll see if we've set the low point already for the VIX. It's really limited in the downside because of just how low it already is relative to the VIX 3M, and then how low the VVIX already is too. It doesn't give us a whole lot of downside potential for the VIX to move down too. All right, now let's take a look at what's driving this price action. It's really interesting. I had a conversation with JC Peretz on his show, his online show that he has, about the move that we've seen in yields and the dollar and commodities year to date has really not suppressed risk appetite whatsoever. Just has been an interesting move. Well, today we kind of saw something similar except for the dollar. Dollar was so bullish last week, but commodities rallied today with the weakness in the dollar, and yields rallied today, which is usually doesn't happen with the weakness in the dollar there. And if you take a look at the 10-year yield, because TLT is the long-term bond, right? So the 10-year yield jumping back up to 4.25%, back above its 8-day moving average. So we'll see if it starts to make a new run higher here. This is what its market forecast looks like. Let's pull up the TNX on the market forecast. You can see we did get that bull tag last week on Friday. Bouncing back up today, though. So we expect that short-term sentiment now will bounce back up. And intermediate line still above market sentiment. So now we'll see if the near-term line crosses through that intermediate line. The dollar did that last week. You can see the near-term line did jump back up above the intermediate. The intermediate line did cross above market sentiment. We're down today, oversold momentum line, near-term line down. So again, you would expect that will bounce back up now on the dollar after a while. I mean, look at that 2-day rally. You're going to have a little bit of a consolidation on a move like that. This is what it looks like on its 2-line version chart of the 3 green arrows. You can see the 8-day and 17-day moving averages are now crossing above the 30, which is a good sign that we can continue to trend higher here with a positive MACD and stochastic indicator. All right, and then of course the other main asset class that's been driving things here lately is commodities. Again, dark green shading and the green line. Market sentiment line has finally come out of the reversal zone. Things are looking much better for commodity prices here. Trying to get above the point of control, continue its move towards its 200-day moving average, potentially beyond up to this $24 level. Again, it's the big driver here is crude oil prices. Crude oil had a good jump today up to the top of its value area, above these moving averages as well. And you can see that it's been so steady. It really hasn't moved very much, so it hasn't had a very strong trend necessarily, but the intermediate line is still above market sentiment. It's actually still above the 80th percentile as well, and your near-term line is bouncing. So we're getting a move higher, and you expect that will probably continue to get a little jump higher, which again, recently, the last few years has been bearish for equities, but just not year to date. When you look at the year to date move, whoops, not this one, sorry. When you look at the year to date asset class comparison chart here, year to date, again, you can see TLT is down, which means yields are up. Commodities and the dollar are both up pretty considerably. And that generally has been bearish for risk appetite. It did push, IWM is lagging behind the dollar, it's lagging behind commodities. There is some weakness there, still positive, but relative weakness there. Not the case for the Qs, right? The Qs, it just continues to dominate this market, and you can see if I were to take a look at the Qs relative, let's look at the Qs relative to IWM first. Because again, that's been the relationship that's been so bullish. You can see it's been consolidating pretty sideways here with a strong positive correlation. So it looks like we're trying, like the MACD is right on zero. So the long-term PPO is falling, but everything like this, these two lines are right on top of each other. The MACD is right at 0. The RSI is right at 50. I mean, it's about as sideways of a move you can get in this ratio chart, which again signals that we are flirting with a kind of a squeeze play type maneuver here. If you take a look at like today's breadth, remember that's been an important thing to kind of keep an eye on. Looking at the McClellan oscillator, we're back to negative after a pretty decent positive week last week. We're back down to negative levels there. The money flow, which is something we also look at on the S&P, on the SPY specifically. Again, we're up to new highs, but we're not up to new highs in the money flow. The index, the oscillator is still at 60, but you see a much lower high than what we've seen. If you look at it on a weekly basis, it's still extreme on the weekly basis. But you see that on the daily charts. It's just it doesn't have the same strength. And you see that as well in other charts like the dark pool index and the gamma exposure. You can see the dark pool index has been gradually moving lower. The gamma exposure, again, typically peaks when the S&P peaks. The peak of the gamma exposure occurred way over here before that convergence period, and then it's been lower ever since. So both gamma exposure and the dark pool index buying has been very extremely low and declining during this rally, and that's a reflection of that breadth of just not looking as positive. Even though we did get a pretty mature bullish sign with the number of stocks above their 200-day moving average getting above 400, getting up to 410 even. Now it's kind of floating with getting back below 400. In fact, even the average is almost up to 400, 20-day average. That's a very, very mature sign of a bull market. As you can see, if I zoom out, let's even go out 20 years here. It's not too common to get above 400. In 2021, we did pretty. It's a pretty strong move higher in very inflationary environment. Pre-COVID, you can see we got above 400. Even the average did, and you can see what happened. 2018 we did, coming off of these lows in 16 and 17 we did. That was a very strong period for the market as well. 2017 QE led to a lot of stocks above the 200-day moving average before we had this global slowdown of 15-16 right before 2011. Drop, we were above that 400 level. Same thing with 2010, and then of course we started to really diverge. But we were initially above 400 in 2007 before we started to cut rates. Right, cutting rates actually brought this down instead of pushing it higher, and that's kind of where we're at right now. Post rate hike cycle, we're back to where we're above 400. The number of stocks above the 50 is dropping, but still above its moving average at least, which means the ratio is back above 1, right? So here we are back above 1. Again, making a new run higher would not necessarily be the most bullish thing. Has been lately, but previously that wasn't, right? This was a bullish, bearish move. That was a bearish move. This was a bearish move until we really spike to the upside, and that usually happens right at the lows, right, or near the lows is when we get these spikes. But again, those spikes tend to occur at the end of a bullish trend on the ratio. So it looks like we're kind of forming a new low point and trying to bounce back up, and we'll see if that ends up being the case. The new highs and new lows index, another sign of breadth, is back below its moving average, but at least it's still positive. So you haven't really started to show signs of weakness. I mean, this is a sign of weakness, but very, very small sign. Nothing too major yet. Getting below zero is a different story, and we've been able to only get below zero very briefly and very minimal drop below zero there. Let's take a look at how the sectors have performed. So bear with me 1 second while I get that sector chart up. Whoops. Let's look at the, well, we can look at the 12 grid first. Again, dark green shading and green lines across the board here in all these cyclical areas, even energy. Really, real estate's the only one that's not. And then healthcare, both showing light pink shading and a yellow line on the bull tag, but everything else. So pretty broad move from that perspective. Looking at the comparison chart, and if you look at that year-to-date comparison chart. All right, so let's go year-to-date first, and then we'll zoom in on today. Again, XLC, XLE, and XLF. I mean, these are sectors that don't generally move together. XLI, XLK kind of matching up there. So it's a lot broader of a rally. XLY is not participating, and you can see your interest rate sensitive areas not surprisingly struggling during a move higher in interest rates. Staples and healthcare also lagging. They're considered to be safety trades. If I were to go now to just today, again, a very, very small move. Energy was our bigger mover today. Utilities was up. Materials also doing well. Again, with the weakness in the dollar, sorry. But look at XLK. XLK is your big loser. Remember, XLK has got some of our biggest companies, including NVIDIA. So we have XLK down today, even though NVIDIA is up. But you have, Microsoft is down. Apple's still trending lower. Broadcom is down just a smidgen there. AMD is down below its moving average. Adobe is up, but well below its moving averages. And then you can see like Google and Meta and Netflix, XLC stocks all doing very well. And then you have Amazon and Tesla kind of offsetting each other, which is why XLY is kind of struggling, right, to really get going there. All right, that takes us to our trade idea of the day. Let's take a look at Norfolk Southern. It really dropped hard. It came off of its lows after we did the Market Outlook Live, and we put the trade on. It came off its lows a little bit here. Still, the intermediate line is barely above 50. It's going to be below 50. It was below 50 when we looked at it. It's going to be below 50 again tomorrow. Very extreme short-term sentiment, bearish short-term sentiment to the downside. You're down well below the moving average by about 3%, which is more than what we saw during that bull tag period there. So pretty significant move. Dark pink shading again. Red line, light pink shading will be dark pink here pretty soon. If you look at the long-term chart, you can see we have a pretty clear bearish candle here today. There it is. With a red arrow, which means we close below the 10-week exponential moving average. The pretty strong, you can see the size of the candles, pretty decently sized. Much bigger than that little small bearish candle that we had on that small little pullback. No red arrow either. PPO is falling already. Looking at obviously we have 3 red arrows. When you look at the chart here, you can see pretty decent volume today on the decline. MACD is negative, again more negative than what we saw, just barely there. Stochastics is in bearish territory. We broke the 30-day on Friday. We followed through with a break below the 50-day today. Pretty decent sized gap to fill in between the 50 and the 200-day moving averages. If you look at the DMI, you can see the ADX is still above 25, and we're in a pretty volatile move, and you have a break above 25 in the negative indicator and above the positive indicator. It's not quite below 20 yet. When you look at the RSI and the CCI, again breaking down below 50 in the lower half of the chart, and almost breaking below the 40% mark. Well below minus 200, so a big time move on the CCI. Looking at the Ichimoku cloud, we had a strong trend. It's gone. We're still above the cloud, but the green, you see well below the blue line. The rate of change has gone negative. When you look at the Bollinger Bands and the Keltner channels, we have broken below the lower band. You can see there's a pretty decent size gap on volume here above the value area. And we were briefly below the lower Keltner channel this morning. And you can see the momentum picking up to the downside. Still has red dots. So we're kind of setting up for a squeeze play. We had a very, very small bandwidth that we're breaking out of. And so an opportunity for more of a directional move to the downside. So what I did is I went to The May options in this case give a little bit more time, just a few days above 50 days expiration. Sold that 20 delta option and bought the 240 and position size here for about 500, right around the $500, getting almost $1,500 of reward. So almost a 3-to-1 reward to risk ratio with this much flexibility in terms of timing, right? It doesn't have to move right now, but the more it can, the better. But that's our trade idea for today. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread. If any questions or comments you have, reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.